Hello, and welcome to today's edition of Beyond Reasonable Doubt. In this episode, we shall be looking at the cost of life insurance. My name is George Wong, and I'm happy to share some really cool stuff with you today. My wish is that I could grab your attention because these are some interesting facts that are going to last with you anytime you think about purchasing an insurance contract. So let's go right into it. Just a reminder for those who are joining in this episode for the first time, September is a life insurance awareness month. So when it comes to the cost of insurance, here are some risk factors, and we're talking particularly about life insurance. The age determines the cost. Of course, the younger you are, the lower the cost, and the older you are, the higher the cost. Gender also determines the cost. So male and female, the costs are different. It comes from life expectancy. So from statistics, women have much longer life expectancy than the men. So as a result, the insurance is a little bit cheaper. So it means the risk of passing away is much higher in men than in women. That's the point. And the lifestyle does impact your cost of insurance. If you're a smoker, you will have higher rates, you'll be rated. If you drink, you have drinking habits, drinking a lot of alcohol. So you take part in risky sports like scuba diving or rock climbing and all the stuff. So you'll be rated. You're not like any normal individual. So your driving record as well, so take note of that. If you have a bad driving record, that can impact your life insurance cost as well. Your health history, evidently, and your family history. So these are the key risk factors that determine the cost of your insurance. And this is where it becomes really interesting, and I would really like to grab your attention. I'll do my best not to encourage one contract over the other. My role here is to give the information so when you get the awareness, the clarity, you will understand which product serves you the best and when to go for which one. So here I took a male individual of 35 years old and requesting for $500,000 of temporary life insurance, term insurance, for a 10-year period. So a T10. So for the first 10 years, they'll tell you have $500,000 of life insurance and you're going to pay only $26 a month. Sounds very cheap, right? Okay. But here is the information I want to get you know. This is the summary page of every term insurance contract, and a lot of people still miss this. The reason I bring this is because I've met numerous clients, and the reason why they don't understand insurance or they don't like insurance is because they think that there's a lot of important detailed information in the fine print and they're hiding the information. Here's the point. This is a summary information in the very first page of the contract, and a lot of people don't know about this, and that's why I want to grab your attention. A lot of people don't know about this very detailed facts on the very first page of any insurance contract. The very first 10 years, $26 a month for $500,000 of insurance, and you think you have a life insurance for the rest of your life and you're going to pay $26 for the rest of your life. Very, very wrong. Even on the summary page, it doesn't say that. In the summary, you can see the first 10 years is $26. The second 10 years, when the first 10 years expires and you choose to continue it, in the second 10-year period, it jumps from $26 a month to $161 per month. That is anywhere between 6 to 7 times the cost. you can see. And in the third 10-year period, it goes from 161 to 385. And in the fourth 10-year period, it goes to $1,000 a month. And in the last 10-year period, if you choose to continue to renew it because you still need life insurance, the cost jumps to $2,900, almost $3,000 per month. This is per month, it's not per year. So now, from the beginning, $26 a month, it was cheap, right? So at the end, $3,000 a month, is that still cheap? So something to keep at the back of your mind. I hope you're really following along. So something to take note here, once you decide to go for the contract, think between paying annually versus monthly. You see, $26 a month or $289 a year. If you go annually, it will save you tons of money. $289 a year compared to if you go with $26 per month, that you end up spending $312 a year. So something to take note of. And to really see the impact, if you decided to go with this contract and you push it all the way till as far as you can go to age 85, then going annually would have costed you $509,000 as opposed to $547,000 if you were paying monthly. So look at how much savings. If you by choosing to pay annually, you save about $40,000, close to $40,000 just paying annually instead of monthly. This is for a term insurance contract, not permanent. So something to take note. So now, having understand this comparison here, I want to relate this to a 10-year and a 20-year period, just to make you see the impact of a long-term risk and a short-term risk. When you go for a short-term contract, that is if you know that the risk is very, very short-term. If the risk is a long-term product, a long-term risk, there's no need for you to take a short-term contract, because when it renews, it becomes more costly. It's better at that point to go for a longer-term contract. So you may think of taking a 20-year term instead of a 10-year. For example, like a mortgage, anywhere between 25 to 30 years, go for a longer term. Don't take a 10-year term insurance for that. So for comparing 20-year and 10-year, the same individual, the same age, for a 20-year, see at the end, if they go push it all the way till age 85, they would have spent $463,000 long-term contract as opposed to the 10-year short-term, where they will end up spending $509,000. Imagine that difference. That is close to about how much? $40,000, over $40,000 of saving between the two. Something to take note of. When do you go for the long term and when do you go for the short term contract? Most often, the only time you pick a 10-year term is, for example, like you took a student loan, and I guess that's why most student loans, they give you a 10-year period to pay it back. So if you are calculating that as a risk as part of your insurance request, you can consider a 10-year term period for that kind of loan. But for a mortgage, you would rather go for a longer term than to pick a 10-year term, because it will end up costing you more. I hope this one is really clear. If you have any doubt still at this point here, I would encourage you to go and drop a comment or a question in the comment section so that we can answer and get you sorted out with this. And now getting into the real operation, how things work within a term insurance and a permanent insurance, I would like to make this illustration for your visual retention. So let me make this sketch here. Say, consider, for example, This is an insurance contract and the cost, how much you pay, and over time in years. Let's say this is a 10-year contract. So here is how it works. From the first year, it's going to cost you this much. Year number 1, year number 2, year number 3, year number 4, number 5, number 6, number 7, number 8, number 9, number 10. So every single year, this is how it works. You are not charged the cost of insurance according to that age. It's not proportionate. What happens in a term insurance is they will take the average cost from the first year to the cost of insurance for the third year, so to the 10th year. So in the first year, let's say the cost of insurance is $10, and the second year, say it is $11, and the third year $13. This would have been proportionate, but this is not what happens in a term insurance. In a term insurance, they take the average from the first year to the 10th year, and the average cost is what you will pay. So if we consider what we did for the term insurance, that costed $26 a month, if you recall, $26 a month, that will be the cost you pay throughout the term, throughout the 10-year period. So, but what happens here is you are not paying in the year you live. You're paying the cost of insurance for years that you have not lived. So this average means you're only paying for the first year and for the year number 10, year number 9, when you have not yet lived those years. So it's not proportionate in the beginning. So, but the difference with the permanent insurance, though, is the fact that with the permanent insurance, you pay as you go. If I would simplify it, if you understand that way, you pay as you go. Let me try to illustrate that here. So similar concept. Pay as you go. Okay. Let's consider this to be a permanent insurance now. Say you get it from age 35, that's year number 1, to age 100. Let's say 35 to age 100. That's your permanent insurance for life. In this one, rather, you are charged proportionately. So you pay the cost of insurance, only the cost for the year in which you live, and not for the years that you have not lived. However, they borrow the concept from the term insurance that how about instead of only paying this $10 per month and the second year you pay $11 for just the cost, how about you pay a little more in advance, but then this will not go to the cost of insurance. The difference would now be invested, will be put into a fund value that is invested every month, every year, and it brings interest and compounds year after year. It's growing at a compounding rate. So for example, for a 10-year period, the same person, 35 years, and say you decide to put about $200 or let's say $300 per month into this contract, what will happen is, though you put $300 a month, this is not going for the cost of insurance. Only the $10 for the year in which you live will be deducted for the cost of insurance, and the difference between this $10 and the $300 is what will go into your fund value. This fund value will continue to grow over the years and is bringing interest and compounding that interest over the years. And by the way, this is a tax exempt environment. so compounding without the impact of taxation. So, but to keep it simple, I need to mention that for the $300, you are not going to pay this amount for the rest of the life of the policy, like it is the case with the term insurance. You pay this because you're paying upfront higher premium. You pay and you stop at a certain period, let's say 60 or 65 when you go on retirement, and this product would have paid out itself. It will self-sustain itself for the rest of your life. And I will go into details when I talk about permanent insurance. You will see what the benefit will be to you. So if you remember with the term insurance that I showed you, if you push it to say age 85, you end up paying about $509,000. In a policy like this, if you put $300 for a period of 30 years, from 35 to 65 is 30-year period, you would have ended up with about $72,000. So imagine $509,000 from your pocket as opposed to $72,000 from your pocket. Now you tell me which one you think is cheap. And now to talk about permanent life insurance. Here is a summary page that I borrowed. I don't want to commercialize any company, but just to highlight some the points you need to take note of when you purchase a contract and the key things to look for. Say you purchase a contract of $250,000. $250,000 is spelled out. This contract is for life. It's not temporal. This is permanent life insurance. It's spelled out there for life. And if you read here, YRT, as I was explaining, is yearly renewable term. So the cost of insurance is renewed yearly. So you're paying the cost only for the year in which you live, not the average, and you pay for the years that you have not yet lived. So, however, you decide to put into this contract $250 every month, not for the entire period of the year, like I explained, but however, only $47 will be taken for the cost of insurance every month, and the rest, the difference, that's about $200, a little over $200, will be invested month in, month out, and that investment compounds every year. And now let's look detailedly at how a permanent life insurance operates. So remember I said in a permanent life insurance, you commit to paying a higher premium from the beginning, but you don't pay for the rest of the policy. You pay up to a certain point and you stop. This is exactly what is happening here. So you see $3,000, if you pay, this is about $250 a month from age 35 to age 65, and you stop right there. If you see here, going forward, this is zero. You don't make any further contribution. This age 85 is because I took only this portion of the illustration. It goes to age 100, so it will last for the rest of your life. So when you stop payments here, the policy does not stop. At this point, it will continue to sustain itself and probably even provide for you. What makes it sustain itself? Because you're paying higher premium upfront in the beginning. Those were compounded in your accumulation fund. This is your fund value, and you see how it started from scratch and grows over time. So when you stop payment, it's able not only to continue sustaining the policy, but it continues to accumulate and grow. As your fund value grows bigger, it's going to force the death benefit, which you had only $250,000 from the beginning. Now you see it starts to grow, and by age 85, if we compare to the term insurance that we looked at, by age 85, you bought a $500,000 term insurance from the beginning, it remains the same throughout, and by age 85 there you would have spent about over 500,000. And after 85, if you don't pass away, all the $500,000 you spend will go away and you don't have any more insurance, you're not covered. So here you started with a $250,000 from the beginning, and by that 85 you're ending up above $800,000 and a cash value of above $700,000, which continues to grow, by the way. So the real take-home message here comparatively is that you bought $500,000 of life insurance in a temporary insurance, and you end up paying $509,000. And if you don't pass away at 85, all of this is gone. You have to die if you want to claim it. So in a permanent insurance, you start only with $250,000 of life insurance, and at the end it costed you just $90,000, and you're ending up with above $800,000 of life insurance and more than $700,000 of cash value. Think about that. This is the summary, the takeaway summary from here. If you have any questions on this, again, I tried from the beginning saying that I'm not selling one product over the other. All of them, they have circumstances where you need them. And by this, I will go to the next point. I like to mention here that getting an insurance is a need to protect the risk and existing risk. There are, most often than not, you may have a mix of both a permanent and a temporary insurance. As much as you don't want to lose money, just pay money somewhere that you don't get it back. The cost too, you may want to consider that. So it's a risk versus cost evaluation. So in a nutshell, this slide, I brought this to bring your attention to the fact that there are some risks that can be taken care of in the short term, like a student loan, some of them in the medium term, like 20 years, a business loan, for example, a 30-year period, you're looking at something like a mortgage, for example. This is a real world scenario. So if you have all of these risks combined and you are seeking for protection for all these risks, you need to assess your total risk. Then you start looking at the cost and then what is affordable. You can design a plan where you have some of it long term, like your estate protection. As you grow over the years, you're growing in value and in assets. You want to protect those assets from some other fees, like the probate, which I will talk about that in some other episode, and leaving a legacy behind. These are significant things to consider. So to have all of this, it means you have part of it permanent and some of it temporal, and those will start dropping off. For example, your student loan, when you pay that off, it drops off within the 10 year, and this risk is no longer there. This cost will disappear. Meanwhile, you continue along in the plan. I hope this is making some sense. And now I really want to thank you for your time that you invest coming here and to follow me. It was a pleasure for me to share this with you. I hope it brought some more clarity to you, and not just clarity, but implementing it is going to make a difference in your life. I personally know of a lot of people, they're eager to protect themselves. As much as they want these things, they are doing things wrong. They don't, with half information, misinformation. We are here this month of September, and this Beyond Reasonable Doubt is a way for us together to engage the community at large. And if you like what you heard from here, please help all of us as a community by liking clicking on the like button, and why not share to some other person who you think can benefit. Do you think somebody that you know can benefit from this information? I will appreciate if you share with them. And most important, if it's really good to you, our next episode might be the best. So why not subscribe so that you get notified when the next episode comes up. Thank you for watching.